Yo, what's up, everybody? It is Tuesday, December 6th. We had another down day in the market today. And as you know, I've been expecting this. We're coming into the December 15th quarterly corporate tax payment. That's going to be a drain of about 100 billion, maybe more. Remember September? I thought it was going to be about 110 billion. I mean, in the end, it was like, I think it was like 155, 160 billion. So when all is said and done, we'll find out what it is. But those quarterly tax drains, and of course the big one on April 15th every year, those are usually negative for the market because they're just, it's a drain. I mean, that's true, sucking out liquidity. It's not what all these monetarist nut jobs scream about when they talk about QT, quantitative tightening. But I want to talk about something today. Folks, the stock market is not an indicator of recession, or for that matter, it's not an indicator of economic boom times. If anything, the stock market is like a coincident indicator. It reflects what is happening with the economy. The economy leads the stock market, and there's a very understandable or a very logical reason for that, is because corporate profits are a function of economic activity. When the economy is growing, corporate profits generally tend to rise, and that's reflected in rising stock prices. And when the economy is shrinking, corporate profits tend to fall, and that's reflected in falling stock prices. So it is not a leading indicator. I mean, just because the market is down a couple of days, I mean, look, the market was making new all-time highs back in November and December. And we went into half of 2022 was a contraction. There was no forecast or warning given or any signal in the market that there was going to be a contraction in the economy. I was the one who was telling everybody here on this channel, and certainly my subscribers, that we are going to see a major cutback in fiscal support in 2022 compared to 2021, and for that matter compared to 2020, because those 2 years, 2020 and 2021, we had major fiscal stimulus because of the pandemic, and all of that, a lot of that was going away this year. So we had that first half contraction, but the stock market didn't forecast that. And because the market is down now 2 days in a row, that's not forecasting a recession either. I mean, you have to be able to see what's going to happen, in the months ahead. And for that, as I always say, you have to look at these fiscal flows, because that's the first derivative of all economic activity. That is the government net spending. Okay, and that either adds to the financial balances of the economy or subtracts. One of the reasons I am saying that we're in a bearish little moment here is because of the tax payments that are coming due next week. That subtracts from the financial balances of the economy. All right? So for me, when I look at 2023, and I've been telling you guys this, I see a continued expansion of these interest income transfers into the economy thanks to the Fed rate hikes. I mean, we see that already. I said it yesterday that the first 2 months of this fiscal year, October, November, we've already had almost 50 billion poured in. Okay, and that's just getting started. Most of that was really only from the discount on T-bills and new issues. I mean, we're not even really starting to feel the full effect of interest on Treasury securities, because, as I've been saying, these securities have to mature and new ones have to be issued, and the new ones will come with the higher coupon. So if you're trying to predict the economy, and I know that a lot of people on Wall Street do this, they look at the stock market. As a matter of fact, like, I think one of the components of the leading economic indicators, this thing that economists refer to from time to time, and it's published monthly by the government. I think one of the components is the stock market, which is stupid. I mean, I would even say that the stock market is a lagging indicator. It's not, maybe not even a coincident indicator, because we see there are times when you could see very solid economic growth, and it takes time for the market to catch up because of sentiment. Right now is a good example of that. Okay, we've had bearish sentiment. I talk about this every week. If you look at the AAII weekly survey, I mean, 54 weeks of negativity, and the economy is now they're forecasting fourth quarter GDP growth at like almost 4%. So it's the negative sentiment that is kind of holding the market back. So I don't see that and it's not a predictor. It's just not a predictor of economic activity. It's not. I mean, best case, it's a coincident indicator, which means it reflects what's happening now. And I don't even think, in most cases, like I said, I don't even think it's a coincident indicator. I think it's a lagging indicator. Again, you could say, last year when the market was at all-time highs, and then the economy started to contract already going into the first quarter of 2022, then the market followed, okay? And it didn't start to rally and before we started to see positive economic forecasts for the third quarter and the fourth quarter. I mean, it kind of lagged. So if you do that, if you look at the stock market and think like you're savvy and you're sophisticated and you're predicting the economy, I mean, you're just going to be wrong most of the time. I mean, you might get it right once in a while because it's just luck, or just happens by some circumstance. But I mean, believe me, it's not a leading indicator of the economy. The other thing is that, and this is interesting, I mean, when stock prices change, whether they go up or down, you can talk about market averages, whatever, you can talk about individual stocks. There's no change in real wealth. It's an asset redistribution. I mean, when stocks go up, then some people have more stock and less cash, and some people have more cash and less stock. And when stocks go down, some people have less stock and more cash, and some people have more stock and less cash. It's just like, it's kind of funny because it's the same exact thing. Everybody gets all crazy about inflation. And I've tried to explain so many times that inflation is just, it's a price change, and there's going to be losers and there's going to be winners. It's a redistribution of income. In the case of stock prices moving around, I mean, that's just kind of like, that's an asset. That's a redistribution of assets. I mean, some people are going to have more stock and less cash because they're paying up for the stocks. And then, people are selling, certain investors are selling who bought early, and vice versa. When it goes down, some people are going to have more cash, the ones who sold first, and then some people are going to have more stock at the bottom. So, I mean, that's another thing that's completely misunderstood. And really the only way, the only true way for the stock market to rise over time and stay in an uptrend, and actually this country, I mean, as far back as you want to go, if you look at the stock indices, they've been going up, and that's because of economic growth. And economic growth is a function of many different variables. It could be population growth, it's technological innovation, it could be trade to some extent. We've been through a period now, I'd say, since the 1970s where we got a global economy. Now it's kind of, with sanctions and war and everything, it's something I've been talking about, that the global economy is kind of like going through a fundamental a fundamental change where blocks are being formed, and that's a consequence of the U.S. weaponizing the dollar. By the way, I saw an interesting article that a friend of mine sent me today. Taiwan Semiconductor, the big semiconductor manufacturing company in Taiwan, TSCM TSMC is the symbol. They are investing $40 billion in a chip manufacturing plant in Arizona. Now, some of you may recall the other day I talked about de-dollarization and the forms which it may take, and the only true way for foreigners to rid themselves of dollars, if that's indeed what they want to do. It's not about China selling dollars to Brazil or Brazil selling dollars to the UK. No, it's the same amount of dollars reside in the global economy. But if they want to truly shrink their holding of dollars, they could either buy goods and services made in the United States and pay for them with their dollars, or foreign direct investment. They could invest those dollars here in the United States. And what Taiwan Semiconductor is doing right there, that's an example of de-dollarization. And, that's a trend that I think is going to continue. And it's a way for these countries, if they want to reduce their dollar holdings, they may do it in that fashion. They may see the United States as, an opportunistic place to invest, foreign direct investment. So Taiwan Semiconductor is doing that. That's the biggest ever foreign direct investment in Arizona, and one of the biggest in the United States. So keep that in mind. I think we could see more of that trend. And that also, I think that speaks to, and this is very long term, this speaks to what we may be embarking on, a fundamental long-term shift in the composition of the U.S. economy. Now, this is very secular and long-term. Because basically over the last 40, 50 years, we've been more or less financializing the economy and offshoring. So we manufacture offshore, and the financialization of the domestic economy is like existing assets. We don't make new assets like roads and bridges and infrastructure and manufacturing plants, wherever they exist, and refineries and things like that. And we just leverage them up financially. Maybe we privatize them. So like stuff that we already paid for as taxpayers, we're getting charged again because these assets have been sold off to private investors, and then they're charging us now when they should be free to us because we paid for them. All right, in taxes, infrastructure, wherever you live, your taxes go to building and maintaining infrastructure. And then when they sell it off, and that's paid for, many times over. And then when they sell it off, the new owners, the private owners are just going to tack new fees and charges onto those things. So, we get hosed every single time. But maybe what we're seeing now is the very beginnings of a shift in the composition of the U.S. economy back towards, like a producing economy again. Now, one manufacturing plant in Arizona certainly doesn't, change the reality of the way the U.S. economy works right now. It's still largely financialized, completely financialized. All right. Look at housing, right? And I've said this so many times, there's not a lot that home prices can fall because we just don't have enough supply relative to the population. If you look back at housing starts going back, I think the data on the Fed has data going back to like the 1950s. Every time the housing market has peaked, we've seen annual housing starts at 2 million units or more. Okay? We're not even close to that. I think we're like, I don't know, 1.5 million. And we were in the financial crash in 2008, 2009. I mean, it got down to 325,000. Like, you really, I mean, what? We're 14 years, 13, 14 years past the financial crash, and we still haven't gotten up to a level, that at least historically signifies a top in housing, at least prices. And don't forget, the population has grown in those last 14 years. We were under 300 million. I don't know, you could look it up where we were in 2008 with the population in the United States. But like, I'll give you one example. I think it was like 1974. We hit that was a peak in housing. We hit something like 2.2 million housing starts, and the population was like 180 million or something like that in the United States. Now we're 325 million, and we're only doing 1.5 million new units annually. So it's like, there's not enough. People got to live somewhere. So like, you need to get that number over 2 million annually and keep it there for a period of time to replenish the housing stock of this country. I mean, it's ridiculous. We went down to 320. That was the lowest in history, at least in modern history, 325,000 in the financial crash, and never really recovered. So, that's a problem. So again, this goes back to, we're not creating enough of the real assets that we need to sustain, like a first world nation. I mean, when I travel now, or I have friends that travel, I mean, you go to countries now that previously, we would have laughed them off as 2-bit, third world ridiculous countries. I mean, they have infrastructure that just is way more modern, blows our stuff away. You're talking about like internet access, airports, highways, things of that nature. I mean, last year, what was it? Last year, yeah, like a year ago, I traveled to see my son in Switzerland, and I flew through Istanbul, Turkey. I had a connection there for some reason. I couldn't get a direct flight. I don't know. But man, that airport was unbelievable. And it's Turkey. Like, it wasn't long ago that you'd be laughing at that prospect, or even a little bit, nervous about going there because of what kind of infrastructure is going to be there. Is it safe? But now, we're just not investing in the real assets that we need. Look at our electric grid, right? I mean, that's so outdated. It needs to be upgraded. Look at the air traffic control system. We're still running on, basically, it's an air traffic control system that was like from World War II. I mean, that needs to be upgraded. So we haven't done any of those things. But now, when you start, and again, this is not really a tradable, a thing happening right now. When I'm talking about foreign direct investment into the United States, I mean, that's a long-term deal I'm talking about. But you're going to see it start to manifest in, every month that trade deficit is going to shrink a little bit, it's going to shrink a little bit, it's going to shrink a little bit. So yeah, it's a very interesting development. Keep your eye on that. Anyway, the point I wanted to make in this video is like, don't look at the stock market as a predictor of the economy. The economy determines where the stock market goes. Plain and simple. When the economy is strong, corporate profits are up, people earn more money, and the stock market reflects that. And for the most part, government spending, net government spending, because remember, some entity has to spend more than they than they take in. It could be the government, it could be the private sector, it could be the foreign sector. But in our case, most of the time, it's the U.S. government. That is the first derivative of economic growth. Everything else hinges off of that. You could take my word for it, or you could ignore me and say it's something else. It's animal spirits. It's a technical chart. I mean, you're allowed to believe in whatever you want to believe in. But I'm telling you right now, that is the first derivative of economic growth. And it's going to be that way still for a long period of time. So I don't care that the stock market is going down in December. I said that was going to happen because we have a quarterly tax drain. But looking forward, I can tell you this right now, there's not going to be a crash. There's not going to be a bear market. There's not going to be a recession. 2023, those fiscal flows are going to get really pumped up. All right? And that's a good thing. It's not a bad thing, at least economically speaking. Anyway, that's it for today, folks. See you tomorrow. Bye.